Hi, it's Nero here from Investment Rise, and in this video I want to talk about the current recession Australia is having and its impact on property prices. Why? Because according to an article in realestate.com.au, about 54% of Australians right now are uncertain about the property market and are looking for guidance about, well, is now the right time to buy? Should they wait? Are property prices going to fall? Are they rising? What's happening in our property market? And look, there's no doubt about it, Australia is in a recession, right? I mean, even according to the federal government's reports, there are over 1 million Australians sadly out of work. That's our highest number on record. So with so many people out of work, it's natural to expect, natural to imagine that, well, our property markets would suffer and property prices would fall. And that's certainly what so many people out there who are looking for those sensationalistic media headlines will have you believe, and certainly I guess some of the trolls out there will also have you believe. But have you had a look at the data recently? I was speaking to someone recently who lived in the northern beaches of Sydney, and she said, Nero, we were looking for an investment property to buy in the northern beaches, and when COVID hit in about March, April, we thought property prices were going to fall, and so we just thought we'd stand back, wait for prices to fall, and grab a bargain. But today, and I spoke just recently in early August, she said prices now are higher than they were back then, and we feel that we're missing out. I'm hearing a similar story from people who live in the eastern suburbs of Sydney. And what about, for example, say the North Shore of Sydney house prices? Yeah, they're higher now than they were back a few months ago. In fact, as I record this video in the second half of August 2020, we are seeing auction clearance rates in Sydney at about 70%. Which is similar to what it was back during the actual boom days. In fact, in the Sutherland Shire, a property sold just last weekend for $7.1 million. But get this, that was $1.85 million above the reserve price. Well, what about in Melbourne, which is currently in the midst of level 4 restrictions? Yes, there are fewer auctions happening right now, but of the auctions that are happening, there's a 67% clearance rate, which is definitely on the higher end. And prices are holding strong. In fact, in Burwood in Melbourne, a property that was on auction about 2 weeks ago didn't hit its reserve price and was passed in. Now, the reserve price was $1.73 million. Yet, just last weekend, so less than 2 weeks after the auction, the property sold for a staggering $1.785 million. And in Brisbane, well, selling agents, developers, they're all telling me that they haven't been this busy in years with properties walking out the door. So does any of this sound like property prices crashing? Right? So then what is going on? Well, to explain what's happening right now, I went back and looked at what happened to property prices during the recession we had, our last recession, which is in the early 1990s, what happened to property prices during the global financial crisis, or the GFC, and what happened to property prices during our biggest downturn, the Sydney and Melbourne markets, which, mind you, was not during the GFC, and it was not during our last recession. So before I get to all that though, if you're new to my channel, welcome. Please click the subscribe button and hit the notification bell so that you don't miss out on any of my future videos, because I do aim to upload a new video once a week, and hit that like button for me as well. All right, so let's have a look at what happened during the last recession we had to have, which was in the 1990s. Property prices fell 4.4% between June 1989 to October 1990. Now, 4.4% during a recession. Does that sound like a crash to you? I mean, do you think you'd even notice if your property price, if you had a home worth, say, $1 million, to keep my numbers easy, and it dropped by 40 grand to $960,000, do you think you'd even notice that? Right, but that was what property prices fell then. Okay, but then what about the GFC? Well, during the global financial crisis, there was something that was a little bit different. Just prior to the GFC, which really arrived in about 2008, interest rates were rising. And with interest rates rising, it made mortgages less affordable or more expensive for people, so property prices were already on the decline. And then the GFC arrived, and property prices around the country fell by, depending on which report you read, anywhere from 7.5% to 7.9%. So let's just say, round numbers, it fell by just under 8% across the country. However, some areas were impacted more than others, with certain inner city unit markets, for example, dropping by over 10%. So that was the GFC, but what happened shortly afterwards? Well, interest rates dropped, mining investment increased, and a short time later, prices started to rise, and we soon after the last global financial crisis, we hit the biggest boom that Sydney and Melbourne have ever had. So, however, I said that the biggest downturn we've had in the Sydney and Melbourne property markets was not during the 90s recession. It was not during the GFC. It was during about mid-2017 to mid-2019 when property prices in Sydney and Melbourne across the board fell by about 11%. And yet, no one's even talking about that. Most people didn't even realize that property prices had fallen by that amount, unless they unfortunately bought a off-the-plan unit which happened to be completed, and when they went to get finance approved on those off-the-plan units which they thought that would be okay, that's when they found out that property prices had dropped. So what caused that property price correction, and what caused it to be so steep and to be our steepest in the last 20, 30 years? It was the lending criteria. Yes, interest rates were still low, not as low as now, of course, but they were still low for that time. But it was the lending constraints. In other words, banks simply said they're not going to lend as much money, especially to investors, but many first home buyers were also impacted. And as a result of people not being able to borrow as much as they could have maybe a year earlier or certainly 2 years earlier, they couldn't afford the property prices, and hence prices fell. So it had very little to do with our economy, which was doing very, very well. It had very little to do with interest rates, which as I said, were low. It had to do with lending constraints. Now, why do I mention all that? Because I think when you look at all of that, it explains what's happening in the property market right now and what I expect to happen going forwards. Because interest rates right now, record lows, 0.25%. The Reserve Bank has also said that they expect interest rates to stay this low for at least 2 years, maybe even 3 years. So we are going to see a period of record low interest rates for quite a while, number one. So then after property prices are dropped so much, in mid-2019, lending constraints were eased again. Interest rates will continue to drop, and they in fact dropped to 0.75%. And so our property market actually started to rise. So just before COVID hit, our markets were actually solid. They were strong. Prices were starting to rise. And now with COVID, what's happened is that the recession that's been caused is not because there was a weakness in the economy necessarily. Rather, the recession was caused because we caused it. We turned off the economy, I guess that's the best way to describe it, in order to try and save lives. But as we turn the economy back on, things I expect will go back to where they were before COVID hit, and property prices will start to rise. But the other thing is, during this COVID-19 crisis that we're having, property prices haven't fallen, as I explained earlier on, but it's due to a couple of factors. Number one, people are holding on to their properties. There are fewer properties available on the market. So that's number one. Number two, as I said, we do have record low interest rates as well. And there are still people who are in positions where their jobs are secure. They don't have any issues from an employment perspective. So for them, now is a great opportunity to get into the market. Now is a great opportunity to maybe secure a bargain or maybe have less competition. Although even in Melbourne, when they have up to 30 people on registering online for an auction, it still shows there's a lot of competition out there. So what I think you're going to take away from this is that I hope we're not going to see those disastrous predictions of markets dropping that we have seen in the news. We are going to see, however, I believe the COVID-19 situation will highlight the fundamentals of every market. And what I mean by that is this: those markets that have very tight supply, where demand is greater than supply, those markets will continue to perform well, and you'll see those prices rise. In other markets, especially suburbs, where there's a huge oversupply in the unit market, and with very little migration happening at the moment, or zero really at the moment, and I don't see migration really going back to its previous levels for quite a while yet, you're going to see those suburbs really suffer. So if you're someone who's thinking about buying a unit in a suburb just because you want to get into a capital city, especially as an investment, you might find that's a bad choice. So we've got lower stock in general. We're going to have a flight to quality, so the better areas where there's a greater demand than supply, those areas will do well. Where the areas where the equation is reversed, where there's greater supply than demand, those areas will struggle and prices will almost certainly fall. And so the question is then, well, what do you do? As an investor, I think the opportunities right now, there are many opportunities out there, but you're going to have to think a little bit differently. You may not necessarily be looking to buy in your local suburb. You might want to look at maybe if you're in Sydney and Melbourne, you can't afford something that in an area that's growing, a suburb that's growing, look outside of Sydney and Melbourne. Right? Maybe look to Brisbane, a city that I believe has great potential for growth over the coming years. It's certainly a lot cheaper than Sydney and Melbourne. Or look to regional areas in New South Wales. I think Newcastle has a lot of potential. In Queensland, look at the Sunshine Coast. All right, but certainly there are plenty of opportunities out there for the investor. But if you think you can do what people have done before, is either just wait, and then there's going to be this day when there's going to be the bottom of the market and you're going to know exactly when that is and you're going to be able to jump in, then clearly your crystal ball is working better than mine, because I don't think anybody can actually do that. On the other hand, if you also think you can just, buy in a suburb that you know that's close to home and think that, that's going to be okay and it's going to go up in value, no. I think even in Sydney and Melbourne, some suburbs are going to go up. As I said, some will go backwards. You're going to have to be a lot more strategic. You'll probably want to get some ongoing guidance and advice. But certainly, if you would ask me, do I think property prices are going to crash across the country? The answer is no. The evidence is showing that, and that's all I'm trying to illustrate here. We're seeing record sales, like I said, in the Sutherland Shire. A couple of months ago, we saw it in Ryde in Sydney. And Melbourne will follow suit as soon as these level 4 restrictions are removed, which I certainly hope is sooner rather than later. We're seeing it in certain parts of Brisbane as well. The eastern seaboard is certainly holding up in terms of property prices. And I think that if you're someone who's going to be waiting, like my friend in the Northern Beaches said, she found herself to be disappointed, you might find that you're going to be disappointed as well. However, as I said, you want to really do your research. Now, with interest rates being so low, many people are thinking, there's nothing the Reserve Bank of Australia can do right now to make it easier to buy property. But that's actually not true. Let me explain. In the US market right now, or in America, the Federal Reserve is undertaking a policy known as quantitative easing, or QE. They did it first during the GFC. And what happened? The share market went crazy. And they've literally come in and said, we're going to do QE probably squared, or a time to the factor of 10. In other words, the Federal Reserve has said they'll do whatever they can to prop up the economy. And what's happened to the share market? They're back to now record highs, almost as if COVID-19 didn't happen. Now, what does that got to do with Australia, though? Well, for the first time, as a result of the COVID situation, the Reserve Bank of Australia said they would undertake quantitative easing to the amount of $100 billion. And I don't make that figure up. If you can certainly look it up, it's $100 billion what they said. However, after $50 billion of quantitative easing, so $50 billion worth of money put into the economy, They said, that's enough for now, we're going to hold that other $50 billion in reserve. Not sure what QE is. To give you the very simple explanation, it means that our retail banks have among them about $50 billion to lend out. That extra money is now sitting with them, and as you know, banks make money by lending. And if they've got all this extra money sitting there to lend, and they want to increase their profits, especially after all this time of mortgage holidays and everything else, what do you think they're going to do? They're going to either make lending restrictions easier, but they can only do so much because they do have now new regulations as a result of the Royal Commission being enforced by APRA, which means that you will start to see banks dropping their interest rates and their sticker interest rates in order to make it more attractive to borrow. And if it's more attractive to borrow, you have more people coming in, there's more demand, especially as the economy starts to improve, and then you'll start to see prices rise in many, many areas. So I really believe that we're poised on a precipice where we've been on pause for the market for quite a while. Yes, as I said, some areas are still showing a record highs, but generally speaking, we're on a bit of a pause. Some areas have fallen slightly, yes, but I certainly think that if you're taking the medium to long-term approach, if you're thinking about, is now a good time to buy so you can be in a better position in 5 years' time, 10 years' time, I think the answer is a very strong yes, as long as you do your research correctly, as I mentioned earlier on, because if you do, I think there's some great opportunities and you can really ride this next wave. It's a wave that's going to be unprecedented in Australia because we have never seen the impact of quantitative easing in Australia yet. But based on what we've seen in America, it's asset prices that rise the most, and in Australia we prefer real estate over shares generally as a nation. So I think you're going to see property prices start to rise. Hey, thanks so much for watching. If you found this video valuable and you're thinking you might like my help to help you find an investment property, then head on over to nerocall.com to discover our unique 5-step process that's helped my private client group purchase now well over $66.2 million worth of property. And then if you like what you see, you can book in for a half-hour phone consult with me personally. Either way, thanks again for watching.